When we talk about the best ways to reduce your income tax bill in Ireland, we're nearly always talking about your pension, but not today. Don't get me wrong, for the average person, investing in a pension early and often is still the best way to save tens of thousands of euros worth of tax and simultaneously build a 6 or 7 figure investment portfolio for retirement. That said, pensions aren't the only tax efficient investment option available to Irish investors. There is another tax incentive hidden away in the depths of Irish tax law that allows you to invest your money outside of a pension and receive up to 50% of your investment as a refund against your income tax liability. It's called the Employment Investment Incentive Scheme, or EIIS for short, and here's how it works. The purpose of EIIS is to encourage Irish investors to invest in early stage Irish companies as opposed to, say, investing their pre-tax earnings in a pension or their post-tax earnings in low-cost index funds. Naturally, an investment in an early stage Irish company is going to carry a lot more risk than an investment in a highly diversified global equities fund. To compensate investors for this additional risk and to encourage investment in indigenous Irish companies, Revenue offers investors very significant tax relief on qualifying EIIS investments. At the upper end of the scale, this can be as much as 50% of the amount invested. For example, if you made a qualifying investment of €25,000, you could reduce your tax bill by as much as €12,500. Given that the maximum investment eligible for relief in a single tax year is €1 million, hypothetically, a high net worth individual could use EIIS to reduce their income tax bill by €500,000. The best way of looking at it is that where the rate of relief is 50%, every €2 worth of qualifying investment comes at an actual cost of €1. So in the case of a €100,000 investment, if the businesses were to fail, the realized loss on investment would be limited to €50,000 because again, the investor would have received a tax refund of €50,000 when making the investment in the first place. On the flip side, if the investment is successful, the investor gets to benefit not only from the initial tax refund, but also from the returns on the investment itself. One notable benefit of EIIS tax relief over pension tax relief, beyond the rate of relief itself, is the fact that EIIS is a total income tax relief, which includes income tax on dividends, rental income, and share options, as well as regular sources of earned income. Of course, there are terms and conditions attached to the incentive itself, and given the complexity of the tax law governing EIIS, it is advisable to consult a tax advisor when considering an investment, especially for sizable tickets. For example, there is a requirement to hold the shares for a minimum period of 4 years in order to prevent any clawback of the tax relief claimed under EIIS. Considering the fact that shares in early stage companies are generally illiquid to begin with, i.e. hard to sell, this minimum holding period adds an extra layer of illiquidity that Irish investors must be aware of before committing to an EIIS investment. On top of that, while the maximum tax relief on an EIIS investment is 50% of the investment amount, the exact percentage of tax relief that you're eligible for will depend on the business that you're investing in. If you're investing in a company that's pre-revenue and raising initial financing, 50% tax relief will be available. If you're investing in a company that is raising initial financing, has revenue, but is still within 7 years of their first commercial sale or 10 years of incorporation, 35% tax relief will be available. Investments in more established companies who are raising money to expand into new markets or to launch a new economic activity will be eligible for 20% tax relief. These are the percentages that apply to direct investments or investments through designated investment funds. For indirect investments through a qualifying investment fund, 30% tax relief will be available across the board. However, most EIIS investments will fall under the standard rate bands, and only one provider in Ireland is currently classified as a qualifying investment fund offering 30% tax relief. Fortunately, there are ways to ensure that your investment always qualifies for the maximum tax relief of 50%, but more on that a little later. The EIIS tax relief is calculated by multiplying the investment amount by a specified percentage, which depends on the type of investment investment and how it's made. That figure is then deducted from the investor's taxable income, and the value of the tax saving is arrived at by multiplying the deductible amount by the investor's marginal rate of income tax, typically 40%. It's generally recommended by those in the EIIS space to ignore the first €44,000 worth of income plus pension contributions in order to only focus on income taxable at 40%. If I was to invest, say, €100,000 in a company that qualified for the maximum rate of relief, I would apply a multiple of 1.25x, i.e. 125%, to my investment in order to arrive at the amount to be deducted from my income, i.e. €125,000. By multiplying €125,000 by the higher rate of tax, i.e. 40%, I can see that the maximum amount of relief that can be claimed is €50,000, which is 50% of the initial investment amount. There are also a number of requirements imposed on the company raising funds via EIIS, not least of which is the requirement to self-certify that the company is eligible under the EIIS rules to begin with. On top of that, the company must continue to meet a number of qualifying criteria over the 4-year period to avoid any potential clawback of tax relief. So there is a lot to consider, which again is why enlisting the help of a chartered tax advisor can be a sensible approach. That begs the question, how does one go about finding EIIS opportunities to invest in? Firstly, the Sunday Business Post does an EIIS special which is available in mid-November that highlights current EIIS opportunities. Secondly, there's a website called EIIS.investments, which is a free information-only website about EIIS in Ireland, including a list of the various opportunities that are currently available. The site also provides a list of the latest updates in relation to EIIS tax law. It's here that you'll find information on opportunities for direct investment, investment via a designated or qualifying fund, and investment via crowdfunding. Each of these options are very different and come with different considerations around minimum investment amounts, due diligence, and fees. However, earlier I mentioned that there was a way to ensure that your investment always qualifies for the maximum tax relief of 50%. And that's where the sponsor of today's video, Quintas Capital, comes in. Quintas Capital runs an EIIS investment fund, which is one of 3 funds that currently hold authorization as a designated investment fund by the Revenue Commissioners. What this means is that Quintas Capital can provide investors with the highest rate of EIIS tax relief available. And most importantly, because they invest in pre-revenue social infrastructure projects, they're actively investing in businesses who are eligible for that rate of relief. So how does it work? Well, Quintas describes a 5-step process. Step 1, an investment is made in the fund. Step 2, the fund invests in 3 to 5 companies with no single investment exceeding more than 50% of the portfolio. Step 3, the investors claim 50% tax relief from revenue. Step 4, the 4-year investment is professionally managed by Quintas on behalf of investors. And step 5, at the end of the term, the investor is due to receive a return of invested capital, if any, plus a fixed coupon. Now, there is a lot to unpack there. Firstly, if an individual is interested in taking advantage of the EIIS fund offered by Quintas Capital, their investment must be made by the 31st of December 2025, with new applications closing in mid-December. If that deadline is missed, investors will need to wait until next year, or alternatively, pursue a different EIIS opportunity. Secondly, this fund isn't for everyone, and Quintas Capital doesn't pretend like it is. They offer a calculator which suggests the minimum appropriate income that an investor should ideally have based on the amount that they're looking to invest. For the minimum investment amount of €25,000, Quintas Capital suggests a minimum income of €81,250. That's mainly to ensure that you have sufficient income available to take full advantage of the 50% rate of relief accessed via the fund. Now, that's not to say that if you don't meet these requirements, then EIIS as a whole is off the table. That's certainly not the case. You can still pursue crowdfunding or other direct investment opportunities elsewhere. But if you want an EIIS investment that's going to be eligible for 50% tax relief and directed into Irish businesses with physical assets and cash flow managed on your behalf by a professional investment team, then €25,000 is the entry point. Thirdly, if a direct investment is made, say in December 2025, the investor could theoretically claim tax relief as early as January 2026. If the relevant return for 2025 is filed in January 2026, you'll be able to claim EIIS relief via your tax return once the companies that Quintas invest in file the necessary documentation with revenue, leading to the the issuance of a statement of qualification. In terms of the pre-revenue businesses that Quintas are investing in, think creches, solar farms, hotels, and nursing homes. Businesses with the physical assets and cash flow necessary to provide investors with downside protection while also improving the chances of a successful exit. Before making any investment in any business, Quintas carries out screening, financial and legal due diligence, valuations, and a two-step approval process via an investment committee. Post-investment, there is ongoing monitoring in the form of quarterly engagements with the board, management accounts, and on-site visits. All the while, the exit plan for the investment is agreed at the outset and is revisited at least 2 years prior to exit. Quintas reports to investors on a quarterly basis, including information on the overall performance of the fund and the individual investee companies. Quintas operates by investing in redeemable shares that provide a coupon in the region of 20% after 4 years. Idea being that the companies redeem the shares using a combination of free cash flow and debt in order to provide a return of invested capital plus a fixed coupon. So the upside is capped, but the risk is better managed. During the holding period, the shares are held by Quintas Capital's trustee, IQEQ, but the investor is the true beneficial owner of the shares in each investee company, proportionate to their investment. That begs the question, what are the fees and charges? There's 2 charges to be aware of: a placement fee of 3% and an exit fee, if successful, of 2%. Quintas provides a worked example of how these fees play out in practice. Let's say an investor wants to invest 100 grand in the fund. Accounting for the 3% placement fee, the net investment payable to Quintas will be €103,000. After tax relief of 50%, the true net cost of the investment to the investor is €53,000. After 4 years, there is a hypothetical successful exit, returning the initial investment of €100,000 as well as a coupon of 20%, i.e. 120 grand. From this, a 2% exit fee is taken, leaving the investor with €117,600. The investor's gain on investment is €14,600, which is taxable, plus the tax saving of €50,000, which isn't taxable. This results in a total monetary gain of €64,600, providing an internal rate of return of over 17%. There's no doubt about it that this is a riskier investment than, say, a standard pension investment or personal index fund investment. The shares are illiquid, some or all of the investment capital can be lost if the company fails, and the returns themselves can be subjected to income tax, USC and PRSI, or CGT, depending on the exact circumstances surrounding the investment, namely the holding period prior to redemption. But on the flip side, 50% of your initial investment is being refunded, which provides significant downside protection and a return of invested cash in year 1. So who is this for? Individuals with a gross income of more than €80,000 who have either already fully utilized their tax-efficient pension contributions, are in receipt of significant rental income, are in receipt of significant share options, or are entrepreneurs looking to reduce their tax bill or efficiently extract cash from their companies. If any of those profiles sound relevant to you, then you can register your interest to invest with Quintas Capital using the link in the video description and pinned comment in the comment section. Thanks again to Quintas Capital for sponsoring this video. If you have any questions on any of the EIIS content that was covered in this video, please do not hesitate to leave it as a comment down below. Thanks very much for watching, and I'll see you in the next one.